Hi, this is Rob. Thanks for joining me. I haven't done a video in a while. I've been working on a new project at the daytradingtargets.com website, and it's had me pretty busy programming for that and been doing some trading. And I wanted to share with you the performance for this last week. I have been publishing that on an ongoing basis on the Market Traders Journal website, and you can check the posts there as well. You can also visit the Day Trading Targets website, where I'm looking for some beta testers. We're probably going to go into the beta program starting early next week. So if you're interested in helping out on the beta program, definitely get over there and fill out the form before I close that out, which will be happening any day now. As always, past performance is not necessarily indicative of future results. There is a risk of loss trading of futures. Let's take a look at this last week's trading record. These are the levels for the last week from Monday through Friday here. The volatility has collapsed substantially in the last week, with the daily ranges becoming very, very tight. I'm actually showing an average daily range in the ES of about 9.6 points. I don't know when I'd seen it quite that low a long time, and so it's very difficult with that kind of a range to extract a lot of profit. But what also happens is, when the models are expecting the ranges to be normal, what will happen is it won't have as high of a hit rate as it will while the market is having normal ranges. And so what we have this week in the ES is we hit on 3 out of 5 days of 60%, and that is following a very substantial period of 100% hit rate for a couple of weeks, which was really great. So the average target just being a couple of points there each day. And I have mentioned also in the E-mini value area reports, if you follow that on the Market Traders Journal website, you certainly should if you don't, about the ranges being contracted and to use caution in that respect. So let's go over and take a look at the Russell and see if we were picking up a little bit more range there. Not much more than the ES, actually less range than the ES, same hit rate, about 60%. Again, the Russell is a stock index market, and so it's subject to the same kinds of things that we just discussed for the E-mini S&P futures. And let's go over and take a look at how crude oil did this week. Crude oil last week, as well as this week, was a real big winner. Last week, the average target was, I think, about $540. This week, just over $500 are the targets. We had a lower hit rate this week. Crude oil is a little bit more erratic than the stock indexes just by its nature. We were getting a pretty good run. Same thing with the stock indexes. We were getting a pretty good run of hits there, and then this last week has been a little bit more variable as that particular market consolidated for at least 3 out of the last 5 trading days. And so and that was related to or that was what had caused the hit rate to be a little bit lower than normal on that market as well. But still, $500 per day per contract nonetheless is a pretty good target potential. And so again, another good week for the target approach. Now let me tell you a little bit about this in case you don't know. The targets are essentially an approach of looking at the markets from the viewpoint of the basic question that started the project was, at what level of movement off of the open on any given day do traders start to question whether or not it's gone too far? And so what we find and what we found in our research was that that level is actually pretty consistent. And we did a lot of statistical testing And we found, you'll see there are two levels here, 77% and 94%. There are actually two systems that are going on inside of this scheme. And the 94%, usually those targets are a little bit closer, so they have a little bit higher probability of being hit. But essentially, what I found when I did these initial tests was that there seemed to be a sweet spot around the 77% area. You'll also see that the 77% are a little bit more common than the 94%. But that was a sweet spot at around the 77% level where you could kind of get an optimal amount of movement off of the open in whichever direction the market started to take off the open for that day. Now there's another point about this as well. You get off of the open, you usually get most of the movement for the day. The reports for the day come in the morning, and then you get most of the movement happening for the day coming off that open. You usually get most of your range expansion there, at least over time. And then the market will often settle in and consolidate, or it may continue trending or come back down into the range. Those are the three different scenarios that can happen. But what you'll see is that very often when the market comes up and hits these target levels, it will not go further. And so statistically, when the market does hit the target, the probability of it coming back down or not continuing further is much higher than it is during that period just after the open, when the market establishes an initial direction. And so that is the second reason why knowing these targets is very important, is because once you come to that target, there's kind of a decision point that the market has to make. Either it's going to continue, it's going to consolidate, or it's going to reverse and go the other way. More often than not, it's not going to continue, because the mindset of the traders at that point in time are saying, no, it's already gone too far. And so they lose interest and go off to lunch and maybe come back in the afternoon, try to see what's happening, and take the market another way. So this system of daily targets is really identifying a market seasonal, if you will, that occurs on the intraday time frame, is exactly how ranges expand coming off of the open. There's a lot of work done. Actually, one of the most famous trading books ever written, Toby Crable, writing about opening range breakouts. Well, this is not a dissimilar kind of a concept, actually. I mean, mathematically and whatnot, it is entirely different than what he had written in that work. Probably one of the greater trading books ever written. But that same type of a concept of the market expanding off of that opening range is still a valid concept. But if you take those old formulas that were used in that book, if you've ever taken the time to sift through that, it's a tremendously extensive piece of work. But if you've ever, and you know, I've probably been 15 years since I read that, but that concept still applies, but those old formulas really don't work anymore. This is a much more statistical and rigorous type of approach. So that's what I have for you this week. It looks like crude oil was the real winner this week. Actually, crude oil is a great market if you're not trading a lot of size. If you're just trading small lots, just an absolutely tremendous market for intraday trading. And so I urge you to take a look at that market if you haven't already. So that's what I have for you. As always, past performance is not necessarily indicative of future results. There's a risk of loss trading futures. Thanks for joining me. And again, visit the Market Traders Journal site, the Day Trading Target site. And there's plenty of free content there for you on Market Traders Journal. All you have to do to get to it is register there. And so we'll see you again on the next one. Thanks again for joining me.